Well, hello everyone, and welcome out to your university education. And today we're going to go through Forex fundamentals. This is part of our Forex advanced education program. And we always like to start with a reminder that trading involves risk, and there's, of course, reward and risk that we have to weigh. We have to look at probability, and as we do that, we can manage that risk. We can put ourselves in good situations where we risk one to make 3 times or 4 times that amount of capital and so forth. But it's important that you virtual trade, that you gain experience and understanding before moving live into the markets. And like I said, today we're going to talk about Forex fundamentals, and that the fundamentals of Forex are country fundamentals. Remember, we're trading currencies of the major countries of the world. So I pulled this screenshot from usdebtclock.org is the website. And it's a running total, it's a tally of basically the US's financial situation. And as we look at the US financial situation, you can actually do a fundamental analysis. And when you're talking about fundamental analysis, what you're referring to is, the health or unhealthiness of the balance sheet. Now, let me explain this to, if you think about an income statement and all of these types of accounting, let's compare it to an individual. If you were to look at a household and you were to say, okay, let's analyze your financial situation, what questions would you ask them? Well, you would ask them questions such as, how much money is coming in on a monthly or yearly basis? You'd want to know what type of income they have from their job or from other sources, right? And so in the US, they also have money coming in. That's this number right here. You can see US federal tax revenue. So the US or other countries, it's the same principle. They bring in money from taxing their citizens, right? So they charge taxes. And here you can see that the US is bringing in $3 trillion. Not too bad, right? So we would love if our household brought in $3 trillion a year. However, that only tells one side of the story. Again, you would ask that household, okay, well, your income is, just to compare it to a person, okay, you have income of $100,000. Well, what are your expenses? How much money, in other words, is going out? What are you spending? And if we come over here and look at the US financial situation, how much are they spending? Well, currently $6 trillion. If you bring in $3 trillion for the year, but you're spending $6 trillion, you've got a little bit of a problem, right? I would compare that to somebody bringing in $100,000 from their job, but they're spending $200,000 a year in expenses for their house, their cars, their vacations. If your spending is way above your income, which is what's happening here in the US, you're running on what's called a deficit. And here is the deficit, $3 trillion, right? So they're running at a deficit. They're not bringing in enough money to cover their expenses. So what do they have to do with this shortfall? What happens to a person that doesn't have enough money to cover their bills? What do? Well, all of you are probably saying, well, they have to borrow the money from somewhere, right? They have to borrow to be able to pay things off. And the US government does the same thing. They sell what are called US government treasury bills, treasury bonds, treasury notes. These are them borrowing money. So what do you have to do when you borrow money? Well, you have to pay interest on that. And the US government and all governments, when they borrow money, they pay interest. In fact, you can look down here at the total debt, and you can see it in the trillions. You can see the amount of interest that they're paying on that debt. Again, just gigantic, enormous numbers in terms of total and quantities and so on. So this is a problem. We are running at a deficit. And when you run at a deficit, essentially you have to pay off that money at some point in time. What the US government and governments around the world are kind of doing is kicking the can down the road. And they're saying, well, let's just, kind of get through this, and let's print more money, and let's send out checks to citizens, and let's do these things. And as politicians, they kind of, you can understand it from a politician standpoint. They want people to be happy while they're in office. It's very easy for a politician to go, I'm only going to be here for 4 years potentially, or 2 years, or whatever. Let me go ahead and make sure that things are good while I'm in office, and then I'll leave it to somebody else to deal with the deficits and all those problems. Let's just kick that can down the road. And this is not Democrats or Republicans. This is everyone, because we ran at deficits during Obama. We ran at deficits during Trump. We're probably going to run at deficits during Biden, et cetera, et cetera. So, are there, when you look at it from, ramifications, at some point, you can't just keep running at deficits forever. You have to start paying your bills. Now, these countries kind of believe, well, we can always just print more money. Their fallback is, yeah, we owe money, but since we have a printing press where we could literally just turn it on and go print off more money to pay off our debts, we're not at risk of defaulting or anything like that. But that doesn't give you a very good warm and fuzzy. And remember, when you're trading in the FX markets, you're trading the currencies of these countries. And the more they rack up debt, and the more they're likely to turn on the printing presses, it's dilutive. Dilution, think of it like, adding water or something like that, adding other liquids to alcohol. It dilutes it, right? It takes down the alcoholic content. When they print and print and print more money, every dollar outstanding buys fewer goods and services. It devalues everything that's out there. So if they're going to keep printing more and more money, your dollar, your currency, whatever you're trading, your euros, your yen, all of these governments are printing money. Essentially, when they do that, they're devaluing their currency. And so you have to weigh the financial situation of these different governments and kind of say, okay, who's in better shape, who's in worse shape? The US having 27 trillion in debt, that doesn't even actually get to their unfunded liabilities. They have unfunded liabilities way down here in the bottom right of 159 trillion. So in terms of all of this capital, they've kind of decided, look, we'll print more money, we'll devalue currency. And this has been a big argument for alternative currency sources. This has been why people have probably really fallen in love with crypto markets, with Bitcoin and so on, because as the more people understand these concepts, the more they see that the end game for these governments is to print money to pay off these debts, and that devalues the currency. It creates an inflation that's a bad inflation, where basically your currencies, your dollars, your euros buy fewer goods and services. Now, if you click on this little button that says World Debt Clock when you're at this website, you can actually see the financial situation of other countries. And you can see where they're at, debt to GDP ratios and so on. And if you think the US government is alone in this, it's not. So it gives you some comparison of, gross domestic product. So how big is the country? You can see the US is the largest economy in the world, 21 trillion. But, China's just behind it at 14, Japan's at 5, and so on. And then you've got the debt to GDP ratios. The US is running at 125% debt to GDP. Well, Germany's at 168%. The UK's at 312%. Japan, if we come over here, public debt to GDP ratio at 270%. For the longest time, Japan has been essentially the leader in printing money and devaluing their currency. The Japanese yen for many years has gone spiraling lower because Japan really hit problems early on back in the 80s. They had a technology slash real estate bubble that burst, and they've been fighting and trying to battle their way out of that for many, many years. They had an aging population and some problems there. So they've been devaluing the currency, and because of that, the Japanese yen trades different to a lot of these other currencies where it takes a lot of Japanese yen just to equal one of something else. For example, right now, if I wanted to look at the exchange rate between the Japanese yen and the US dollar, it would take over 100. It would take quite a bit over 100 Japanese yen just to equal 1 US dollar, or it would take over 100 Japanese yen to get a euro or to get a British pound and so forth. And so, looking at my screen here, it's 105. So it takes 105 yen to get 1 US dollar. It takes the British pound, it takes 145 Japanese yen just to get 1 British pound. So they've been devaluing their currency for a long time that way. We've got to consider those country fundamentals, and the weakest countries, the ones that you think are going to print money the strongest, the hardest, those should be the weakest currencies. The countries that are in a better financial situation, not as much money printing, not, kind of has organic growth and their economies kind of chugging along, those currencies should trade much better from a long-term perspective. So we would be more bullish on the strong fundamentals and more bearish on the weaker fundamentals, betting on those countries that have weak fundamentals to have weaker currencies. Now, as we look at other fundamental factors, you can look at economic indicators. This is another way to value different currencies, to value different opportunities that are out there. This is a screenshot from forexfactory.com, and it's a website that we use that has a nice calendar and will tell you what's on tap. So we can come in here and quickly glance, and if you look at the color of the folder, it will tell you how impactful it is. So a red would be high impact. That's something that you really want to pay close attention to. Orange, medium impact. Yellow, not very impactful. So it kind of gives you a sense that you can come into the calendar for the entire week and look at what's in red and say, okay, these should be more impactful. Here you can see in the orange, the U.S. had a CPI number. That's Consumer Price Index. That's an inflation gauge. And so it tells you, what the previous number was, what the forecast is, and then once this number hits, so once we pass this time, they'll post the actual result. Each of these economic indicators, again, would have an influence on how the currency trades. So if the US dollar has a CPI number, it's a medium impact. So it's probably not going to move the US dollar dramatically, but it could move the US dollar a little bit as these results come out. And what would we be looking for in that result? Well, basically, since this is an inflation number, it gets back to just what I was talking about. Inflation is basically a devaluing of your currency. When inflation is high, it means that your currency buys fewer goods and services. So in other words, if this CPI were to jump up dramatically and surprise the markets, imagine they were expecting 0.3 and it came in at 0.6. Inflation jumped like that. One would anticipate that the US dollar would drop, in that inflation running rampant, it's still a very low number, but if it was much higher than expected, and especially if CPI was running really hot, imagine that this number was in the 3%, 4%, something really high, well, then it could have dramatic impact on your currencies. Here we're still working off of a very, very low number. But if it jumped up more than expected, people would say, well, currency devaluation, et cetera, there could be an impact to that. Usually, a simple gauge is if the number is better economically than expected, the currency will go up. If it's worse than expected, maybe the currency will go down. That still gets a little bit tricky. It's not always perfectly straightforward. That that just because it's a good number, that doesn't guarantee the currency will go up. Maybe it's kind of a buy the rumor, sell the news. Maybe they were expecting it to kind of come in better than expected, and so it kind of sells off after the announcement or something like that. But usually, the general guideline is if it's a strong economic number, it's good for the currency. If it's a weak economic number, it's bad for the currency. You'll notice that central banks are always more high impact. So here we have the Federal Reserve chairman. The Federal Reserve is the U.S. the probably the biggest impact to how markets trade, more than who the president of the United States is. The president of the United States really has a lot less impact on global markets than does the central banks. And the central bank is the one that sets interest rate policy and initiates, different programs for bond buying programs and such. So this is the chairman of the Federal Reserve, Jerome Powell. And because he's speaking, it's high impact because markets are going to say, well, what might he say that can move the US dollar? What if he comes out and says the economy is strong and better than expected? Well, the US dollar can rally up on that. What if he says, we're still in this weak environment, we can't raise rates for a long, long time, and so on? Then the US dollar is likely to sell off. And so his commentary, his approach to the markets, those are going to have an impact on how that currency trades. And it would be the same thing if the Bank of England governor was speaking, or the Royal Bank of Australia, or the ECB chairman. So all of these leaders of their respective central banks, when they put out a message, that can move the currency accordingly. Now, that's economic numbers as we look at their impact. You can also look at figures that have direct impact, such as, let's take a GDP number. This is considered the broadest measure of a country's economy, and it represents the total market value of all the goods and services produced in a country during a given year. Remember, we looked at the GDP numbers for the US. We compared them to the figure for China, which was just below, and then below that was over in Europe and Japan and so on. So GDP is basically how big is your economy. It's kind of like looking at companies and saying, how big is this company? How much is it growing? How is it doing? So that's what we're doing when we look at countries. We're saying, how big are you? What trajectory are you on? How strong? How weak? And we're doing that type of analysis. So if GDP was growing rapidly, one would anticipate a stronger currency. If GDP was deteriorating, meaning that the economy is producing fewer goods, fewer services, in an economic recession, for example, the currency is likely to be weaker accordingly. And now, finally, we can come into stock charts. And once we've done our fundamentals and really looked at countries and kind of made a game plan, what countries do we think are strong? Which ones do we think are weak? That's kind of a watch list, right? And so all of you, after seeing this, can start to go out and do your fundamentals and just make a column. Just basically say, what I would do is just start to analyze some of these numbers and say, well, which ones do I think I want to be bullish on, meaning I expect them to be stronger, and which countries and thereby currencies do I want to be bearish on, or in other words, I expect their currencies to be weaker, and make a list. And as we do that, when we look at this, we can look at this from the standpoint of risk and reward and probability and so on. So for example, if I were doing this analysis right now, I would kind of look at things in terms of where we're at economically and where we're likely to progress. I would have to put the US dollar on a little bit more of a bearish path because they're very much in the money printing phase, sending out stimulus checks, sending out a lot of things to try to increase economic activity. They're in a money printing phase. On the more bullish side of things, you could put countries like Australia and New Zealand, which they may not have as much booming economies, but their currencies, when you kind of look at them, their interest rates are higher at 1.5%, which tells you higher interest rates globally versus the US, which is basically at a zero rate policy, 0.25. I would put Europe over here, the euro, a little bit more on the bearish side of things, just in terms of comparison. And now we've got some ideas. We've got, okay, these are stronger, these are weaker, and we can start to look for trading opportunities. So as I come over to a chart, I can look at this and say something along the lines of, let's just pull up an Aussie US dollar chart. I'm going to pull this up live in the markets right now. Let's pull up a chart here. This is the Aussie versus the US dollar. And I know that I think that the Aussie is going to be stronger, the US dollar is going to be weaker. You can actually see right out of the gates that that's what's been happening overall. This chart goes from, kind of a sideways over here where not a lot was happening through August, September, into October. We would call this a big sideways move. Then it went on a big trend higher. So the Aussie has been much stronger than the US dollar. We're currently in another consolidation. But fundamentally speaking, I would anticipate that this is going to break out again and go to the upside. So because I've done some fundamental homework and I know where a stronger country and economy is versus a little weaker, and a money printing and a stimulating, and all of those things that come with trying to get your economy to speed up, I've got a currency pair that I could look at. And when I get a setup on the chart, I can actually take action. So I always break it down like this. Fundamentals tell you what to buy. What do I trade? What do I buy and sell? It's the what. And we've come to the conclusion Aussie up, US dollar down, right? What do I trade? The technicals, the chart, tells you when to do it. And if you marry those two, and we'll get to more technicals in coming videos and classes and so on, the fundamentals tell you what to trade, what to be bullish on, what to be bearish on. The technicals tell you when to do it. Where is the setup? When do I want to buy? Where do I put my stop loss? What am I targeting? That's all from the chart. So it's a lot of fun as you start to gain more information, more knowledge about how the markets work, and you can start to put those pieces together. Hope you've enjoyed this video. Have a great rest of your day. We'll see you next time. Goodbye.